Sometimes when an investor takes a flyer on an unproven company, the price soars to the stars, and sometimes it crashes and burns. It's far too early to say which will be the case for the first speculative play I made for my Grand Twins college fund, but I certainly have no reason to complain so far. 17 or 18 years from now, my grandsons Logan and Jack will be the beneficiaries of the portfolio I'm funding for them. And they sure don't seem to be complaining either, do they? After all, the flyer I took has beaten the market at every turn. In fact, the small add-on buy I made last July has performed twice as well as the S&P 500 index. And now I've bought it again, taking another shot at the stars. Hi everybody, my name is Mike Nadell, here for the Dividends and Income channel. Before I talk in depth about this company and the 3 others I just bought for my Grand Twins college fund, I'll ask you to give us a thumbs up, subscribe to our channel, and also ring the bell so that you'll get notifications of new videos as we publish them. The company I talked about in my opening is DraftKings, symbol DKNG. It's a growing digital sports and gambling operator, and it just went public last year. I first decided to buy DraftKings for Logan and Jack's college fund last June. While I liked its potential, the fact was it had yet to make a profit, and that's still the case. But I'm building the Grand Twins college fund through small investments, mostly $25 or $50 at a time. And I think it's okay to be bold. It's okay to maybe take an occasional flyer on something speculative. My first buy of DraftKings for the portfolio last June 26th was at $33.33 a share, and it's beaten the overall market since then. The second buy came about 3 weeks later, on July 13th, and I paid $31.50. Since then, the stock has gained almost 70%, and that's twice as good as the market. If you look at any chart of DraftKings price over time, there are so many peaks and valleys. It looks like a roller coaster ride, and it's given investors plenty of thrills and chills. The stock price tends to rise on every bit of good news for the gambling industry, and then it falls when the news is considered anything less than ideal. The swings can be 5% or 8% or 10% or more in a single session, so DraftKings is not a stock for the faint of heart. On May 7th, the company presented an outstanding earnings report, handily beating revenue estimates and boosting full-year sales guidance. As a result, analysts have become even more bullish on the company. 17 of the 24 analysts surveyed by TipRanks called DraftKings a buy, and their average 12-month price target represents a 39% upside. As I built up other positions in the college fund, I hadn't added to the DraftKings stake for about 10 months. In the middle of May, the price kept falling despite those fine earning reports and despite the optimism of analysts. So I took another bite at $41.84. In the week since, the price moved up nearly 20%. And although I expect DraftKings to be a long-term holding, that kind of instant feedback, well, that's always fun. I also made 3 other college fund buys in May, adding to the McDonald's, Constellation Brands, and United Health Group positions. I'm making small, regular investments in the college fund, committing at least $100 a month. Jack and Logan aren't even 2 years old yet, so my plan is to keep this going for years. I call this a growth and income portfolio. Even though I love proven dividend payers, I think it's important to have the opportunity for serious growth in a portfolio with the kind of long-term goals this one has. I started building this portfolio almost a year ago, and it now has 16 stocks and 1 exchange-traded fund, or ETF. So far so good, with a total return of more than 20%. I'm always updating the portfolio's homepage on our Dividend and Income website, so if you'd like to learn even more than what I'm talking about today, check out the link in the description at the bottom. Okay, so we've already talked a lot about DraftKings. Let's talk briefly about the other stocks I bought in May. Constellation Brands sells beer, wine, and hard liquor. It also has taken a large stake in a cannabis company as it bets on the gradual legalization of marijuana. United Health Group is America's largest health insurance company, with more than $250 billion in sales last year alone. And then there's McDonald's, which obviously needs no introduction. Mickey D's is one of my largest positions in my personal portfolio, and I've been loving it for years. Constellation Brands and United Health have outperformed the market by miles over the last decade, while McDonald's has kept pace very nicely. And all 3 companies have outperformed Mr. Market lately, with United Health leading the way. These are financially strong companies that have competitive economic advantages over their peers. They've been growing their dividends nicely too. The contrast between these established blue-chip corporations and a newcomer like DraftKings can be seen quite easily in what I call quality metrics. The quality of McDonald's, Constellation, and United Health is reflected in the way their share prices have zoomed up as investors bid them higher. They all have sky-high forward PE ratios. Still, analysts are quite bullish on them. They're all strong buys on TipRanks, with an average upside of just about 10%. Over the years, every company in the college fund will be overvalued at some points and undervalued at others. So I'll be dollar cost averaging into the positions, and I won't obsess about valuation. Please remember, I did not make this project public to try to convince you to copy what I'm doing. No, I just want to present interesting candidates for further research and to discuss portfolio building concepts. All right, I admit it. I've also made it public so I can show off photos of my adorable grandkids. Now let's talk for a second about the income part of this growth and income portfolio. I'm a dividend growth investor at heart, so I appreciate companies that pay reliable growing dividends. 5 of the college fund stocks paid dividends in May, and those 5 brought in $2.47, which was reinvested right back into the same companies. That dollar amount obviously is low. But you know what? It was 17% higher than the same 5 positions generated just 3 months earlier. Growth will always be the biggest part of the Grand Twins College Fund. But as the portfolio matures, income eventually will become a more material part of the picture too. The month of May meant a lot more to me and my wife than the $2.47 generated by the college fund. Our third grandson, 7-month-old Owen, came with his parents all the way from Seattle to visit us in Charlotte. They even brought me this cool Seattle Kraken hockey shirt. Like Jack and Logan, his older cousins from Chicago, Owen really knows how to brighten Grandpa's day. Check out that smile. I think Owen knows we're going to start his college fund soon too. I also manage another real money project, Income Builder Portfolio, which started back in 2018. I'll be talking about my latest picks for the IBP in my next video for the Dividends and Income channel. Again, please give us a thumbs up, subscribe, and ring that notification bell so you don't miss out on any of our new content. Take it easy, everybody. Back at you soon.